Thanks to an Instagram follower, today we react to Shark Tank Barbara Corcoran exposing Shark Tank's Kevin O'Leary, aka Mr. Wonderful, and how he first made his money and how you can as well. The principles in this, especially as related to real estate, are mind-blowing. Let's get right into it.
Switch subjects. What was your first house like?
I bought my first house for $110,000 when I wasn't even making $10,000 a year.
Crazy. Why would you do that?
It was crazy, and I remember I had postpartum depression.
It's funny, a lot of people say that. They're like, wait a minute, why would you buy a house when you're not making a lot of money? There are usually ways to do it. I mean, you can oftentimes rent out, worst case, the entire property. You could house hack. You could turn it into an Airbnb arbitrage if you needed to. People are always like, well, what if you have this debt and then all of a sudden you lose your job or you have to move? You figure it out. You rent the darn thing out. You Airbnb it out. You do whatever it takes. Surprise, surprise, people make it work. And as long as you're getting like a 30-year fixed rate mortgage, you don't have to worry about the crap that happened during the last financial crisis where you had these balloon payment loans where people couldn't make it work.
After I bought it, I thought, what have I done to myself? But it ended up being one of the best investments.
You were single at the time?
I was.
Yeah.
And what I did is I rented all the rooms to my friends. And
how'd you come up with the money?
I basically borrowed $10,000 for the bank thought it was equity, but I actually had a loan for the equity part too. I had no money.
That's hilarious. That's oftentimes, that is a way people will actually start as well. And you're not supposed to do this, but it's not uncommon to borrow the down payment to buy a house. You're not supposed to do that because the bank wants you to disclose all of your debts so they can qualify you for the payment. But here's a legitimate way you could do it. When I go buy a rental property and I put 25% down on, let's say, a $500,000 house, I'm not putting $125,000 down because I had it sitting around in a savings account. If you're literally saving for a house and the money is sitting in a savings account, you're doing it wrong because you generally become quick to spend on other things, on vacations and other crap. If you see the money, you're going to spend it. So what do? When I need $125,000, I take it from a credit line, which is secured against other real estate that I own or the business that I run. And I take that money and I use that money to pay a down payment on the property. Buy a property, get a good wedge deal, buy a below market transaction, which I teach you how to do in the real estate investing course. Remember, link below for those. Use coupon code 10XTheFed for 22% off. You get the live streams as well, lifetime content. And then over time, I work to pay the credit line back. As soon as the credit line is paid off, I go do it again. So I'm really never having money sit around saved up for a down payment. I'm always on the hunt for a deal. When a deal comes up, I borrow the money to go buy it. Similar to what Kevin here did on a different scale, but obviously if you're younger and you don't have credit lines yet, you probably have to borrow some startup money from family or from friends or whatever so you can get started. Just run the numbers and make sure that you could actually rent out rooms to help you cover all or some of your payment.
Yeah.
So I bought the place and I immediately rented out every single room, including the basement.
You hustler, you.
Yeah, and it's all my friends, and I made them pay their rent every week.
This was in college?
It was just out of college, right out of college.
He made people pay their rent every week. That's brilliant, because now you have control of this money longer, and there's less risk, because if the end of the month rolls around, it's like, all right, guys, you got to pay all the rent. It's like, oh, I don't have the $800 for my room. It's a lot easier for people to come up with $200 every week than $800 at the end of the month. I know that sounds silly because it's the same math. That basically reiterates the argument of the more money you have sitting around in your account, the more likely you are to spend it. So wow, collecting rent payments every week, that's brilliant.
And then what happened was real estate prices started going up. Mm-hmm. And then I realized, oh, this works. My house is worth 20% more after a year, and I've been paying off the mortgage, and I raised everybody's...
you had them paying off the mortgage.
Well, I did, and I raised their rent. And
how to make friends. That's why you don't have friends today. That kind of a gimmick, yeah.
I think that's the thing, is people like Barbara here, people think that's a gimmick. But it's actually brilliant. I mean, the people would be renting a room from somebody anyway. If you were like them, you'd be renting from somebody anyway. You may as well replace your landlord, control real estate, take advantage of the fact that prices go up. Your payments do not when you have a 30-year fixed rate loan, only slightly for property taxes and insurance, but that's a small part of your payments anyway. And then overall, surprise, surprise, you start building wealth. You know, next thing we know, people are gonna go, oh, Kevin O'Leary is illegitimate because he borrowed his money to buy his first house. No, nobody's going to say that. Good for him. He hustled. This is good. This is actually inspirational.
Every Saturday night, we're going to have an investment dating party where we just invite a whole bunch of girls over, and they all came.
What a hot house.
And it was a great party. We had so much fun. It was fantastic.
And you eventually sold that house at a profit truthfully, or you tore it down right
I
to the
sold that
foundation?
house 7 years later for $1.2 million, and I bought it for $110,000.
I don't believe you. I'm going to check that, dude.
No, it's true. It's a true
And where
story.
was this house, this mystery
was
house?
It was in a district called Little Italy in Toronto, Canada. And it was a very ethnic area, and I was very comfortable living there. Then all of a sudden it became very chic. It became the hot place to live because it was downtown.
Kind of like our downtown. Same thing happened.
And it got really hot. And then all these little restaurants started opening, and then all these boutiques.
Now, you should already know this, but just in case you don't, there are 3 ways to make money in real estate. And number 1, cash flow. Number 2, appreciation. Number 3, getting a deal below market value. Now, cash flow is pretty self-explanatory. Getting a deal below market value is often also at least somewhat self-explanatory. It's just a matter of the strategies and tips as far as how to get deals below market value, how to negotiate them. Again, that's what we talk about in the course. But the interesting thing here is this, what Kevin O'Leary described, is one of 2 types of appreciation. There are 2 types of appreciation. So within the 3 ways, there are 2 types of appreciation. One is sort of regular population growth in an area, and a second is appreciation that occurs due to gentrification, and then an area experiences what's called catch-up appreciation. That's when you get this really fast booming in values because an area goes from basically a slummy area, which we heard Kevin O'Leary say he was comfortable living there because he had grown up around this kind of stuff, just sort of his implication of saying it was kind of a cheaper, lower class area, and then it gentrified, and that's how we got this boom in value. That's not something you could have predicted, but again, it is clear how real estate enables this to happen. If you were an electrician in the area there, you would have missed the boom if you didn't experience owning real estate. You could be the best computer programmer in the area. Your wage as that electrician or your wage as the programmer might go up a little bit, but you would miss the boom unless you were an owner.
And some guy came to me and said, I'll buy your house for $1 million. I said, never, not, because I was right across from a park. I had a park across from me that used to be where drug dealers operated, but by the time it became chic.
It's baby carriages.
It was baby carriages, right. I said, for $1.2 million, and I'll do the deal, and that's what happened.
What'd you do with that money?
I started my first company with it called Special Event Television.
Really?
Yeah.
Wow, and you owe it all to real estate. One house.
Well, that's a good point. It's true. My biggest first
and yet
return.
you're always on the road saying, don't buy, rent,
No,
rent,
but you know
rent.
something, Barbara? The second company, Special Event Television.
Kevin does constantly say that. That's actually really astute of Barbara because Kevin's always rent. He gives you the flexibility. And it's so dumb because you could buy a place and if you need to move, just rent it out. Shocking. Good call, Barbara.
We sold that 3 years later. That owned Bobby Orr and the Hockey Legends. It owned Don Cherry's Grapevine. They were television formats. I didn't even know what television format was, and I owned it because we created this show. And we were shooting it in Boston. I was doing all the intermission work for the hockey broadcasts every Saturday. I would shoot the shows for the intermissions on Saturdays.
I can't picture you doing that.
It was crazy.
With
And
hair on your head, no doubt.
I had hair on my head, but I was going all over the place. I was a cameraman, a soundman, an editor. I still edit stuff today, but now you don't do it on a Steam Deck anymore. You do it electronically. But that company was purchased for the rights of the formats. And then I started the software company that eventually became the learning
What
company.
did you sell that first company for?
$9 million.
Really? But that company, again, you started with the $1 million you made on that
$1.2 million,
house.
yeah.
Then why are you going around telling the whole world, don't buy, rent, rent, rent?
No,
I hear you say
It's
it
just,
all the time.
But the trouble is, if you can't afford the debt...
You couldn't afford the debt. You found some other suckers to pay
Barbara,
for it.
when people blow their brains out in real estate, and you know this, is because they over-lever. They own too much real estate. I only owned the house I was living in.
This is true. This is so good. First of all, I'm so happy. Like, Barbara is just picking Mr. Wonderful apart here. Like, it was real estate. Going back to it was a real estate that let you turn $1 million into $9 million and into more. Look at Grant Cardone. Grant Cardone made the bulk of the money that he used to start Cardone Capital from a single family house. Look at Ben Mala, the person who makes videos about how he's buying $20 million retail spaces and apartments and hotels. Where did he make his first money? single family and duplexes. And now Kevin O'Leary joins. But what he is saying, Kevin O'Leary's distinction here is accurate. If you're worried about debt, you start by living in your place, owning your place, rent out the rooms to help you cover the payments and insulate. Where people get hurt, and this is also true, this is where people get hurt, is they buy a lot of rental real estate and they keep doing the Burr method. They keep doing the refinance. And then all of a sudden they have 10 properties with a ton of debt. 10 properties with too much debt and equity lines on every single property without paying them off, without not refinancing. I like to be very conservative with my investments. That's how people get screwed because they're trying to grow too big, too fast. This is good.
Barbara, when people blow their brains out on real estate, and you know this, is because they over-lever. They own too much real estate. I only owned the house I was living in, and I was running a little business out of the basement, and I renting all the rooms to all my friends. I mean, that place was like some sort of college dorm for a while.
That's exactly what it was.
It was like 10 people in there, you know? But everybody's paying me $250 a week, and I was living off that. That's how I was eating. If somebody didn't pay me rent, I starved. I lost weight. So I was really kind of a slum landlord, sort of like you if you think about it.
Oh, yeah, just like me. I'm hardly a slum landlord. I spoil my tenants. They're like my children.
How many tenants do you have now?
Probably maybe 65, 70.
It's crazy. You know
I just
them all?
bought a new building.
Do you
Now
know
I have
them all?
30 more. Of course I don't know them all. I know their checks.
But you know that you have managers manage the buildings, right?
I have very good managers, but I take care of my buildings. You take care of your tenants, they take care of you back. That's what I've learned. Like all
that
the
makes
rest
sense
of life.
to me. So you make sure they have a good entrance. You paint the
Doll
places,
it up,
all that
make it
stuff.
look good. You treat them well. You answer their complaints. Sometimes
They're
I don't want
renting
to.
these places.
Of course.
Yeah,
You know what's great about tenants renting a place? You could keep remortgaging your property again and again and again, taking cash out, and then as the rents.
You can do that, but that's the Burr thing that I was talking about that gets people in trouble. It's okay to keep remortgaging if you're making lots of money and you can afford these extra debt payments, then it's okay. But there's that balance there, and you're kind of seeing that dichotomy here between Barbara and Kevin.
Go up, the tenants can afford the rent, and so you're still making tons of money as you go.
You get capital returns and you get income.
Oh, it's not just the income. You can remortgage, you get chunks of cash out without paying taxes.
What could go wrong in real estate?
You could have a recession, but as long as you don't overcharge on your rents, I always factor that in, that prices could drop 20%, and it's still a good building and still can pay the mortgage. Like you said earlier, don't over leverage.
So if you assume when you model, you pencil it out, that the 20% decline could happen over a 3 or 4 year period.
Yeah, you take a lesser mortgage and the building could actually support.
So you put more equity into the building.
You do, yeah, eventually, or you leave more equity in without mortgaging out quite as much.
Yeah.
Look at that. Look at Barbara just correct basically exactly what I had said. In fact, my favorite leverage number is having no more than 65% debt, because that actually gives me a 35% buffer in case the market moves. And I also follow the principle of renting slightly below what I think the property is worth, which keeps my vacancies almost to zero. These are very, very good principles.
Okay.
Yeah.
So
have you bought real estate for investment over time?
I have, and I actually have about 35% of my portfolio in real estate, but they're all income-producing properties like cold storage facilities.
So it's things you invest in, not things that you manage, right?
Yes. Well, those facilities, I actually did some construction loan financing. I built some and I bought some, and I built a portfolio and then a REIT. Again, 3 partners.
You never talk about this. I wish you'd promote
Yeah, no,
real
I
estate.
did it, and I learned something very important. On the very first construction financing, because we were new into that industry, the bank made us sign personal guarantees for the first building to prove we could do it and stabilize it within 36 months. That was the deal. They'd lend the money to build it. This was a cold storage facility. And then after it was stabilized, they would refinance it. But during the unstabilized period, they wanted personal guarantees. Now, I had never given a personal guarantee before.
Hard to do it without it.
And that was 2007. Then 2008 came. Whoa, that scared the living you-know-what out of me.
Because you did give a personal guarantee.
Pretty much any kind of single family, duplex, triplex, fourplex, and even a lot of commercial deals, even Ben Mala says this, will be what are called personally guaranteed financed deals. In other words, that's totally normal. There are times you can get what are called non-recourse deals, where the bank cannot come after you if the project goes bad, but those loans tend to be a lot more expensive. And in my opinion, Mr. Wonderful here was probably speculating on that cold storage investment. The fact that he said he took an unstabilized property, got a construction loan, and then had to stabilize it, it sounds a little bit like speculation at very bad market timing on top of that. That's exactly why, and I feel like a broken record here, but that's exactly why I say do not speculate on real estate. I do not speculate on appreciation. I guarantee my properties are bought under market value, and that makes me feel comfortable because there's no speculation. There's none of this crazy construction financing either.
Funding without it, truly.
But it taught me an important lesson because you should give personal guarantees as if you can afford to lose them. That is the only way.
That wouldn't cover most of us.
I know, but it really was a scary thing because there was a couple of weeks in that period where, we were really soberly looking at it saying maybe we got to take the hit on this because we're not sure what the economy is going to do. But we stuck it out. We continued to pay. It made the stabilization an extra 12 months, so we had to wait 4 years. But we sold that building for a massive profit coming out of the recession.
Good for you.
Yeah, it was amazing. But I learned my lesson about leverage in real estate. But what I like about real estate that I own now, they're all income producing properties. I did a hotel in Boston, which was a crazy experience, a boutique hotel. Pros and cons to that. The real estate building value was worth more than the hotel was.
Of course, which is true of most boutique hotels.
Yeah, and so that's what saved our Heine. We were losing money operating the hotel, and then somebody just came out and said, I want that facility.
Of course.
That's so common. That's exactly why I say stick to the easy stuff. The residential real estate, whether it's people in apartment buildings or single family or smaller stuff that you can rent out, that's great. The easiest way to start, obviously, is replacing your landlord and then moving up the ladder. But that's very valuable there. You start getting into like hoteliering, you better have like a degree in managing a hotel. But the buildings, those can oftentimes be easy investments.
It's true of most boutique hotels.
Yeah, and so that's what saved our Heine. We were losing money operating the hotel, and then somebody just came out and said, I want that facility.
Of course. You were saved by the bell, so to speak.
Saved by because we were losing a lot.
Yeah. Here's an interesting story that just happened to me last week. I'm buying a 35-unit building.
Yeah.
Going for the financing, giving the true rent roll, exactly what it is. The building could easily support a mortgage of up to 80%. And the bankers would not believe me that was the real rent roll. They asked me how much I had padded it. I'm like, that's the real rent roll.
You mean it was
how
that
much did you
high?
pad it? They wanted it padded. They wanted to show a higher debt to value ratio, and they would not take it on face value. I went to 3 different banks. Everybody wanted the numbers padded. I'd never experienced that before.
They wanted you to lie to them?
Basically, yes. I'm like, this is how it goes. It's called hard money lenders. It's kind of like legal mafia.
And you were just trying to negotiate a mortgage, right?
All I wanted was a regular mortgage based on real numbers, and I had a hard time being truthful. I finally found a lender that wanted the truth, but everyone I went to wanted to hear a story.
And what can you get mortgages for now? 6%?
No, not on an investment property. It's more like 7, 7.5, 7 3/8.
Wow.
Yeah.
By the way, this 7 3/8 and all that's hard money. This is why I like the residential small deals where you're paying like 3.75% or 4.25% on your money.
So that's not cheap anymore.
Not cheap, but if you have a good property, it makes sense. Yeah, but I was just surprised at the lack of honesty in the whole process. I thought I had seen and heard it all. I'm like, you got to be kidding. It took me a while to catch on as to what they were looking for. These are respectable banks.
Is there any restrictions on how fast you can pay that mortgage back?
No. I mean, there's
no
prepayment penalties, of course, but you don't want to rush to pay a mortgage back quickly.
Yeah, no, I understand.
Unless you sell.
Yeah, if you
Unless you sell, then it comes due.
Well, that was absolutely mind-blowing and fascinating. I cannot believe that Kevin O'Leary made the bulk of his money, which started pretty much everything after that with a single family. The other insights we got from real estate, absolutely incredible here. This is by far going to be one of my favorite reactions because this is such a real example, and we really just got into 2 incredibly powerful people's brains regarding real estate, and it surprisingly aligns with exactly what I teach. And people wonder like, oh, Kevin, are you just trying to shove a course down our throat? No. I, as a real estate broker, helped people do exactly what Kevin did on his first property. This area is up next to boom. This is how much you could rent the rooms up for. Here's how we could remodel it cheaply but safely so it's a quality property and make money on the deal. Folks, follow me on Instagram, and until next time.